So let's start with Occidental Petroleum and its deal. For more, let's bring in Neal Dingmann, who heads energy research at Truist. Neal, welcome. Good to have you with us. Is this proposed deal an overpayment on the part of Oxy for this company? They pay too much?
I don't think so. I mean, I wasn't surprised by the deal, a little surprised by the price, as you pointed out. I think, number one, it still is very free cash flow accretive. And number two, I think Oxy's got a number of assets that it can sell in order to pay for this, lower returning assets, Tyler, that make this deal makes it a lot of sense.
You say they need to reduce debt by about $4.5 billion in divestitures because they're borrowing a lot, sort of like I think it's $9 billion in cash to do this deal.
That's right. So you figure about 6.5%. You know, obviously, if they can pay and sell something $4.5 billion in the first 9 months, it'll cut a big dent in that. Really helps with the accretion. So again, plus you think about it, the assets they're going to sell, I believe, are certainly going to be lower margin assets than these, or low return assets, I should say, than these. So that too makes a lot of sense to swap out to these higher assets.
So let's go back to what they're paying. 6.3 times 24 cash flow, and when you compare that with other deals, isn't that a much higher multiple that they're paying? And does this company deserve it?
It's definitely on the high side. You know, it's more in line of what we saw on the Chevron deal, on the Pioneer, or on the Exxon deal, where 24 doesn't stick out. But then when you start thinking about the efficiencies, the upside they'll probably get on 25, then it starts making more sense. So again, I would tell you, certainly higher than number of private deals, but as far as the last two big deals we've seen with Pioneer and Hess being purchased, I think it's very much in line with those. And really, to me, the big accretion really starts in 25.
And the balance sheet is sufficiently strong, in your view, to pull this off. And they seem to think so, in that they are increasing their dividend to 22 cents a share from 18 cents a share. You don't do that if you're worried about your balance sheet.
That's right. I think that's indicative of them, of what they think the free cash, number one, free cash was going to do in the very near term, and number two, the balance sheet. But I'd still go back, even with that balance sheet, it's still going to be critical for them to sell a number of assets. I'm talking billions of assets in the very near term.
And so $4 billion of lower value assets is the target that you have in mind. Are you expecting more such deals between now potentially and year end? And will most of those deals, if they do eventuate, will most of them involve private companies, as this one is, public companies buying private companies?
I think the simple answers are yes and yes. I think there are a number of privates that want to monetize, want to cash in before the end of the year. Nothing this size. By the way, I don't think anything this size, but I do think there's a number of deals here at Houston, Midland, you name it, especially the Permian Basin, that I think would love to cash out at anything near these prices. And oftentimes these privates like to cash out right before the end of the year.
Yeah. What is it? What is the magic about the end of the year? Just to get it done cleanly, or what? Tax-wise?
That's right. A lot of them raising new funds for the new year. And if they can show a big gain before the end of the year, it really helps to raise funds for that next go around.